Welcome to StockScope. Today, we perform a forensic analysis of Tesla's Q1 2026 performance. We are moving past the amazing abundance rhetoric to look at the mechanical reality of the business. In 2026, the primary question for any investor is simple. Is the current market cap supported by industrial reality, or is it floating on a robotics smokescreen? We lay out the engineering of the balance sheet. You decide the verdict. The headline numbers signal a fundamental shift. Total revenue has contracted sequentially to $22.38 billion, down from $24.9 billion just last quarter. More critical is the collapse of the GAAP operating margin to 4.2%. This is no longer a high-margin software narrative. It is the margin profile of a legacy industrial manufacturer. Income from operations has eroded to $941 million, a steep fall from the $1.4 billion generated previously. The StockScope efficiency gap has completely inverted this quarter. Tesla manufactured over 408,000 vehicles, but delivered only 358,000. That is an excess of 50,000 unsold units, rotting metal that consumes capital while sitting in overflow lots. Global inventory has ballooned to 27 days of supply, nearly doubling sequentially. This suggests that price cuts are no longer stimulating enough demand to clear the lines. To sustain the AI pivot, capital expenditures have surged to $2.49 billion. Tesla is pouring billions into the Cortex-2 cluster and A15 chip development, while the core cash cow segments stall. Energy storage deployment, a supposed pillar of growth, cratered from 14.2 gigawatt-hours to just 8.8 gigawatt-hours sequentially. Free cash flow has decayed to $1.44 billion, a massive drawdown from the $3.99 billion peak seen in late 2025. The bull thesis now rests almost entirely on the data moat. Cumulative FSD miles have reached 9.2 billion. With the Cortex-2 cluster online and the A15 processor tape-out complete, the compute infrastructure is world-class. However, an analyst must ask, can this infrastructure be monetized fast enough to offset the accelerating decay in the automotive business? We are witnessing a violent rotation in revenue streams. Services revenue is up 42% year over year, and paid robotaxi miles nearly doubled sequentially. But the core engine is failing. Model 3 and Y deliveries fell by over 64,000 units sequentially. The demand ceiling for Tesla's hardware has been hit, and software is not yet filling that multi-billion-dollar hole. The disconnect is total. Retail is buying into the unsupervised Autonomy launch in Dallas and Houston. Meanwhile, institutions are watching operating expenses surge 37% to $3.77 billion. Operating leverage is currently being destroyed. Tesla is spending significantly more to make significantly less. Is the robotics vision a breakthrough or a necessary distraction? The bear case is built on the reality of hardware commoditization. Core auto revenue is shrinking sequentially, down to $16.2 billion. Margin suffocation at 4.2% aligns the company with legacy automakers, not tech giants. Finally, the inventory glut of 27 days proves that the market is saturated and current pricing strategies are failing to move metal. The bull case relies on an insurmountable lead in training data, with 9.2 billion miles driven. Proponents point to the Dallas and Houston launches as proof that robotaxi monetization is live and ready to scale. Additionally, the Optimus production line in Fremont is aiming for 1 million units per year, potentially opening a massive new robotics market. The disconnect here is the most dangerous for valuation. Tesla is spending more to make significantly less. While operating expenses grew 37%, income from operations fell to $941 million. The Amazing Abundance mission requires billions in ongoing R&D, while the cash cow, the Model 3 and Y lineup, stalls in its growth trajectory. Taking a technical look, we can observe how the stock is mid-range, positioned between two historical and ascending important floor and supports. Neither you have a bearish or more of a bullish approach. The stock has found a reactive zone over last months, and this means an entry and battling zone where the stock can skyrocket to the 480 levels or plunge to the 280.